In a world where Australia accounts for less than 3% of global stock markets, it's vital for Australian investors to allocate at least part of their portfolios to global markets. But doing so raises questions about currency risk, different disclosure standards, and increasingly the dominance of the USA. And with global equity ETFs now representing the largest segment of Australian ETFs, with $157 billion invested, isn't it time that your portfolio got some of the action? That's after this. Hi, I'm Vince Scully, Portfolio Manager at Life Sherpa Invest, and this is Investing. And today, we're going global. But before I get into individual funds, let's be clear about the overall landscape that we're talking about. And for most people, we're going to be talking about indexed investing. And there's three main index providers. There's Morgan Stanley Capital Investors, or MSCI, or MSCI. There's the Financial Times Stock Exchange Russell, or FTSE Russell, depending on how you feel, and the more obscure Solactive. They classify countries around the world as either developed, emerging, or frontier, based on economic development, market size, liquidity, and market accessibility. And for most part, we're going to ignore the frontier markets. So we're really talking about developed markets and emerging markets. So there's a fair bit of commonality among the providers. So for all of them, developed markets include, of course, Australia and New Zealand, Hong Kong, Singapore, and Japan in Asia, USA and Canada in the Americas, and most of Western Europe. That's the UK, Ireland, Portugal, Spain, France, Germany, the Netherlands, Belgium, Italy, Switzerland, Austria, and the Nordics, being Norway, Sweden, Denmark, and Finland. And perhaps questionably, Israel. There are a few subtle differences, though. So MSCI considers Greece to be a developed country, but FTSE and Solactive both consider it to be an emerging market. FTSE, however, have said they will move it from the emerging category to the developed category in September 2026. Both FTSE and Solactive include Poland in the developed list, whereas MSCI does not. The big one, and we'll come back and see how important this is later on, FTSE classifies Korea as developed, while both MSCI and Solactive consider it emerging. And the main argument really is around access to the market and how foreigners can get access to various features of their market. And you might say that's just semantics, Vince, but they matter when you try combining ETFs based on indexes from different providers to create your portfolio. And for me, the big one to watch here is Korea. And you'll either double up or miss out depending on how you build your portfolio. The second thing you need to think about is company size. So you've probably heard me talk about small caps and large caps in a previous episode where we talked about equities generally. But large cap or capitalisation companies are those with a market capitalisation, that is the value of all of their shares listed on the market, greater than about 5 billion up to the trillions. So the top 4 or 5 companies in the world these days are in the $4 trillion range. Mid caps typically between 1.5 billion and 5 billion. And small cap are those between 200 million and 1.5 billion. And they're, of course, US dollars. And contrast that with Australia, where $1 billion Australian market cap gets you into the ASX 200, and just 100 million gets you into the ASX 300. And even our largest companies, BHP gets you to about 200 billion. So what's small cap globally would include some large caps in Australia. So it's important to keep that in mind when people bandy the term small cap, large cap around. Think about which market you're looking at. And the third leg of this equation really is currency. Part and parcel of investing overseas is the shifting value of the Australian dollar relative to the currency in which the share you're buying is traded. And being the unimaginative finance types you are, we call that currency risk. And looked at from the perspective of an Australian investor, investing in overseas assets, especially those denominated in US dollars, does provide an element of stability. And that might sound a bit odd when you think about it first, and this will be very different to the perspective of a US investor. So when you're consuming content on YouTube or on the internet generally, you need to look at the geographic perspective of the author. So looked at from an Australian perspective, as global markets stumble, investors generally flock to the US dollar, or the USA specifically, and to gold as safe haven assets. And what this does is push up the value of the US dollar relative to other currencies. And the Australian dollar, along with the South African rand and the Canadian dollar, fall more than most currencies because we're seen as a risk-on currency and our dependence on commodities. And of course, when recession strikes or economic downturns happen, demand for commodities fall, demand for the Australian dollar falls. So you get this double whammy effect where if you're holding a share that trades in US dollars, even if it falls, the fall in the Australian dollar cushions some of that blow. So that's a really important function for an Australian investor. And for this reason, along with cost and confusion of investment outcomes, we would generally not seek to hedge overseas equity exposure or equity allocations. Part of why you're investing overseas is currency diversification. And so paying money to hedge that away strikes me as a particularly dumb thing to do. And if you do want to take a position on the currency, so if you want to trade the currency or you believe the Australian dollar is going to rise, then take a position in the currency. Don't muddy the equity investment decision with a currency position. And finally, we need to address the elephant in the room, and that is US dominance. And particularly in the last 5 years, so post the pandemic, the US market has come to represent a bigger and bigger slice of global markets. So much so that the USA now represents 73% of the MSCI world, that's the developed market, excluding Australia. And the last time we had anywhere near this level of dominance was Japan in 1989, when Japan got a 45%. Today, Japan represents 5.5% of the index, which is about the same slice as NVIDIA on its own gets. Now, I'm not suggesting in any way that the USA is heading for a Japanese-style correction. But the US represents just 24% of global nominal GDP and much less, like about 14%, on a purchasing power parity basis. And so that should serve as food for thought before choosing to allocate 73% of your global equity investment to the US. And at LifeShip Invest, we take a much more fundamental approach to country allocation. And our USA portion of our global allocation is about 40%. So 40% of our global allocation, that's our ex-Australia equity exposure, is about 40%. And that we'll see shortly that that's not too far where the average Australian investor is. So having set that scene, now I think it's time to consider how that plays through to how you should choose to invest globally. And for most beginning investors, and even most sophisticated investors, there's a wide range of ETFs that provide a convenient and relatively cheap way to invest in global equities. So much so that there's $157 billion of Australian investors' money invested in ETFs listed in Australia that are invested predominantly in global ex-Australian equities. And that compares to $87 billion in Australian equity funds. So put that another way, for every dollar that Australian investors invest in Australian equities, they invest $1.80 in overseas equities. So that's about 36% Australian, 64% global. So that's pretty close to 40%. So overall, a fairly good average result. But we do see a lot of younger investors in particular, whose main experience of investing is in the post-2020 timeframe, so the last 5 or 6 years. But if you go back behind that, so in fact, if you look at, these things do move in cycles, and if you go back to the period from July 1997 to June 2019, the ASX 200, that's the 200 largest shares on the Australian share market, outperformed the S&P 500. But quite clearly in the last 5 years, the S&P 500 has materially outperformed. And over the decade, the NASDAQ, the tech-heavy second market in the US, has outperformed that quite materially. So it is important to remember that these things do move in cycles. We should be wary of recency bias and always keep in mind that diversification is your friend. Which brings me on to the point about, well, which ETF should I choose? There are dozens of global equity ETFs on the Australian market. And I'm going to ignore the currency hedged options. There are a reasonable smattering of those hedged back to Australian dollars. And so I'm going to exclude those for this analysis. But there are hedged versions of some of the funds that I'm about to talk about. But as I said, I believe, and we strongly implement, that global equity exposures should not be hedged back to Australian dollars for all the reasons I've talked about. So starting with the US, biggest single market, and choosing a USA-only ETF allows you to manage how much of your portfolio is allocated to the USA rather than relying on global index allocations. And this is our approach at LifeSherpa Invest. Indexes, market capitalisation weighted indexes in particular, are a great way to allocate your investment within a market. So generally buying a market capitalisation weighted portfolio of Australian shares, Australian large cap shares in particular, is a good way to allocate your portfolio to Australian large caps. But it's a terrible way to allocate between markets or between asset classes. So be careful about how you interpret the index funds outperform active funds. That really isn't a good way of looking at between classes or between markets. So the big players in the US, the S&P 500, the Standard & Poor's 500 index, which tracks broadly the 500 largest companies in the US. There are 2 ETFs that track that. There's the iShares S&P 500, or IVV. It's got $13.1 billion in funds under management, so it's a big player in this scheme. It's got a very small MER, or management expense ratio, or ICR, indirect cost ratio, depending on what you want to call it, of 0.04%. That is close to close to zero. It's also got a very tight spread, so the buy-sell spread when you're looking to trade these things is as low as 0.03% or 3 basis points. That's as tight as it gets, really. And 4.3% of the fund turns over every month, so pretty liquid. All of those are positive signs when you're looking at a broad market index fund. Its closest competitor, which tracks exactly the same index, is SPY, the SPDR or State Street S&P 500 ETF. It's much, much smaller at $397 million assets under management. It's got a slightly more expensive cost ratio of 0.09 or 9 basis points. It's got a much higher spread, which is largely reflected by the size of the fund. There's just fewer people buying it. And a similar proportion of the fund turns over every month. So they track the same index, perform almost identically apart from the fee differential. And so IVV's lower fee, significant larger size, and slightly lower spread make this our pick for an S&P 500 fund. The other market in the US is the NASDAQ, which started life as a second-tier market, and it tends to attract more innovative tech companies. And the main player here is a fund called NDQ, which tracks the NASDAQ 100. So it's the 100 largest shares traded on the NASDAQ market. It's pretty big as well. It's got $7.7 billion under management. It's got a higher cost ratio, which is partly to do with the slightly higher costs of trading. It's a slightly less liquid index. But I think part of that is that it doesn't have any competition, and the market has delivered higher returns over the last decade. So people have been happy to pay a little bit more to get into it. So 0.48 management expense ratio. It's got a very tight spread, again, 3 basis points, and 4.5% of monthly liquidity. So they're all good signs. And the NASDAQ has outperformed the S&P 500 by a very wide margin over the past decade. It's delivered an average 19.88% annually compared to the 15.42 annualized for the S&P 500. Now, this is largely driven by the performance of tech companies. So, on average, members of the NASDAQ 100 are more growth-oriented growth-oriented companies. That is, they tend to trade on higher multiples. They tend to deliver higher growth. Whereas the S&P 500 includes a lot more stable, older, more value companies. NDQ, of course, is more volatile and has experienced very significant drawdowns in the past. And the gap is narrowing. So, in fact, in the last quarter, the performance differential is the other way. The S&P 500's outperformed the NASDAQ. And looking at the NASDAQ history, if you go back to 2000, the NASDAQ peaked at 5,048 on the 10th of March 2000 and fell for 2.5 years, down, reaching 1,114 by October 9th, 2002. Now that's a 78% fall. And it took 15 years to recover. So this has been a trade-off between, great past performance in a market where growth companies have dominated. So the Magnificent Seven in the US in particular have driven those returns, whereas the evidence would suggest that value companies, think the sort of companies that Warren Buffett would buy, have generally, over time, outperformed growth companies. largely because if you pay more for a given set of cash flows, you should expect a lower return. That's not proven true over the whole market for the past decade, probably. But yeah, reversion to the mean is an actual thing. And there's quite a lot of overlap between these two indexes. So about 85% of NASDAQ 100 companies are also in the S&P 500. The top 10 holdings on the NASDAQ index, or in NDQ funds specifically, make up 48.2% of the total value of the fund. And those same 10 companies all appear in the S&P 500 as well, where they make up about 38% of the value. And on balance, we think this extra concentration is undesirable. Nevertheless, if you invested in the NASDAQ over the last decade, you'd have made close to 20% a year. So, yeah, that's a great outcome, but past performance is no indication of future performance. And hindsight looks like a great decision. At the time, maybe it wasn't such a smart move. The fourth big fund in the US is the Vanguard Total Share Market. This is a particularly American-centric view of the world. What it means is the total US share market. And by total, it means it doesn't just stop at the top 100 on the NASDAQ or the top 500 on the S&P. It looks at every listed company, all 3,000 odd of them. And therefore, it's got a investment in mid-caps and small caps. A relatively small investment because it's a market cap weighted fund, but it should have a broader spread, which in theory should give you greater stability and better returns. That's not actually proven to be the case, but if you've read J.L. Collins' Simple Path to Wealth, Hayward, VTSAX and Chill. So VTSAX is the US equivalent of this. And in fact, VTS, the Australian ETF, is in fact what's called a CDI, a Certificated Depository Instrument. So effectively, when you buy a VTS on the ASX, you get a certificate which says that a subsidiary of CHESS has actually gone and bought one of these US units for you and held it on trust. That creates a bit of complexity. It generally creates a little bit more volatility, particularly around balance dates. And the US ETF that it buys, the VTSAX, is one of the funds that owns Vanguard, the manager. So a very small portion of the assets in VTSAX are actually invested in Vanguard, the fund manager. And it's got an obligation to make good losses or expenses that Vanguard incurs. So that's a bit of a complicating factor that we don't really like. But, it is a very large fund at $6.3 billion, so it's very popular. Again, very small management expense ratio of 3 basis points, 0.03%. It's got a very tight spread of 0.04, although that can blow out when you get those dislocations in the US. And it's got 4% monthly liquidity. So all of those are good markers of a good ETF. We don't like the CDI structure if we can avoid it. VTS has underperformed IVV over 1, 3, 5, 10 and 15 years. And the complexity of the CDI structure and the Vanguard ownership risk makes us focus on IVV as the pick for a US market exposure. If you do want to add mid and small cap, you could look at IJH for mid cap. That's an iShares fund, or IJR for small cap. But in our view, if you're looking to invest in small cap, you really should be looking at an active manager, and in particular an active small cap value manager. There is no ETF to do that, so you'll need to move to the managed fund market. But IJH and IGI will give you an ability to overweight small and mid caps. Does add complexity. We don't do that in our LifeSherpa Invest portfolios, but for larger tailored portfolios, we would use an active small cap value manager. So that's the US. When we come back after this, we look at the rest of the world.
This Is Investing is brought to you by LifeSherpa Invest. If you want your money to work harder and not just sit in a savings account earning crumbs, check out LifeSherpa Invest. Choose from 4 risk-based portfolios like Everest 90 with 90% in growth assets. Long-term, low-cost and built for people who are after serious returns. Invest from $5K today at lifesherpainvest.com.au/invest and start climbing.
And we're back. So now let's move on and look at the rest of the world. So if we want to look at a global fund, so it's effectively our one-stop global equity allocation, we start with the funds that include the US. So this is where you, in fact, accept the index weighting of the US in the global index rather than separating them out as we like to do. And the monster here is VGS. That's the Vanguard MSCI Indexed International Shares ETF. And that tracks the MSCI World, excluding Australia, in the development. So the MSCI World is a developed index. And that's in contrast to the all countries world. So you've got the MSCI World, which is developed, and the MSCI ACWI, or All Countries World Index, which includes the emerging markets. This is a $14.2 billion monster, very low management expense ratio of 18 basis points, 0.18%. It's got a very tight spread, 2 basis points, and reasonably good monthly liquidity at 3.8%. So all of those good markers, and this is a developed market world. The other one that's worth looking at, which is much more of a large cap fund, and IOO, the iShares Global 100, tracks a Standard & Poor's index, the Global 100 index, which is that fund's actually invested in a US listed ETF. It's 80% USA, 4% UK, and it does include both China and Korea, both of which would ordinarily be classified as emerging markets in MSCI. So this is really looking at 100 large players around the globe. So it's very much a large cap, 100 stock concentrated portfolio. $5.4 billion funds under management. So again, big player. Slightly higher management expense ratio of 0.4%. Reasonably tight spread at 5 basis points and slightly lower liquidity at 2.8%. So still reasonably good. But this is very much a large cap fund, and it does include some emerging markets. And the third player here is BGBL, which is a beta shares fund, which tracks the slightly more obscure Solactive index, so Solactive GBS Developed Markets ex-Australia Large and Mid-Cap Index. It does include a few companies that are incorporated in emerging or frontier markets, but are listed in developed markets. They're mostly African miners listed in Canada. That's not a bad thing. It's just something to keep in mind when you look at the construction metrics of these methodologies for these indexes. It's a $3.3 billion fund, management fee of 0.08%, slightly higher spread, 0.07%, and good liquidity at almost 8%. This is quite a popular fund among younger investors. And then I guess the final player in the global, including US space, is IWLD, the MSCI World ex-Australia. It's an ESG leaders index, so it used to track the MSCI World Developed Index, including the USA, but it changed to this ESG, or Environmental, Social and Governance Screened Fund. It's not a particularly strong screen, but it does skew the holdings slightly. But that change obviously did materially change the thing you're investing in. And so $1.5 billion fund, management expense ratio of 9 basis points, spread of 9 basis points, and reasonably good liquidity at 5%. I'm not sure that the ESG screen adds a huge amount of value here. It's not particularly tight, and but it is an MSCI index, and that's going to be important when we come back and have a look at it. So for our money, looked at on its own, if you're looking for a developed market index, VGS is our pick in this space. That's the Vanguard Global Share Index. Now, because we like to separate out our US investors, we now move on and look at the funds that look at the world excluding the US. And the big player here is VEU, the Vanguard All World ex-US, which tracks a FTSE index. Now, this is important. It's USA domiciled, which creates US tax. You've got to sign that W-8 Ben form every 3 years. And depending on how much you got invested, there can be US estate tax issues. And like VTS, it's exposed to Vanguard ownership risk. Of course, that's a small risk, but we always believe that you should only take risks you're being rewarded for. And in the case of VTS, we don't really see that. Plus, VU, on the other hand, which I'll come back to in a moment, is probably one where we are happy to accept that risk because of the lack of alternatives. So this is a global fund, developed and emerging. So it gives you that spread across the broader market. $5 billion fund, 4 basis point management fee. All these single-digit basis point management fees are as good as zero. It's got a very tight spread, 7 basis points, and good liquidity. The developed option, so developed markets ex-USA, IVV, which is an iShares fund, it tracks the MSCI EAFE index, Europe, Asia, and the Far East, which, although it sounds as missing a few continents, does actually include all of the developed markets. It's a relatively small fund at $647 million. It's got a slightly higher management expense ratio at 32 basis points. It's got quite a wide spread at 0.59, and it's got modest monthly liquidity. But it is one of the few ex-US developed market funds available. The new kid on the block here is ex-US, which is effectively BGBL without the USA. Very new, very small, just $36 million under management. A slightly higher MER, lower than IVE, but higher than the other ones at 0.14. Reasonably wide spread at 0.17, and very high monthly liquidity, which you often see at 32%. So 32% of the fund changes hands every month. You often see that in a new fund where the new money coming in each month swamps the funds under management already. So you can't really pick a a favourite here. VU is one that we use in our portfolios, but you'll see why in a moment. It's to do with the way we put them together. So that brings us on to emerging markets. And IEM is probably the big one. Well, IM and VGE probably. But IM, iShares Emerging Markets, it tracks the MSCI Emerging Market Index, dominated by China, Taiwan, and Korea and India, which together make up 3/4 of the index. And it also includes Poland, which some of the other players consider to be developed. At $1.4 billion, this is a serious player. Relatively higher MER at 0.69. Reasonable spread, 0.11%, and almost 4% monthly liquidity. So slightly higher MER, slightly higher spread, but they're reasonably good scores. The next one that's worth having a look at is EMXC. That's a MSCI Emerging Markets ex-China. And this issue of China is one that bothers a lot of emerging market investors as to whether you include China or not. Sometimes Chinese companies listed in Hong Kong are included, whereas investing in Chinese A shares, relatively recent phenomenon that historically non-accredited overseas investors weren't allowed to buy shares directly in Chinese companies. So, but when you count China in, it starts to be a big portion of your emerging markets. So this one is a ex-China index. It holds only an Irish domiciled fund, which is US denominated. It's $400 million funds under management, so not huge, but acceptable. It's got a management expense ratio of 0.25%, slightly wide spread of 0.31%, but good monthly liquidity at just over 5%. We can then move on and look at the VanEck EMKT, which is a multi-factor emerging market. So it tracks the MSCI Multi-Factor Emerging Markets ETF. And again, China, Korea, Taiwan, and India make up 80% of that fund. Now, the multi-factor bit is worth dwelling on for a moment. So if you remember back to one of our earlier episodes, we talked about the 5-factor model that helps to explain most share returns relative to the market. So you've got the market factor, which broadly, most shares will move up and down with the market. How much they move relative to the market is called beta. The next one is the size factor. So big companies generally underperform small companies. There's the value growth factor. There's the momentum factor. So this fund weights the proportion based on those factors in the index. So it's slightly different to the standard MSCI factor. Sometimes these are called smart beta funds because they try to algorithmically harvest some of those excess returns. It's a medium-sized fund, $456 million under management. Not hugely different to the core MSCI, but a little bit. Higher MER at 0.69%. So that's getting up towards active type fund MERs. It's got quite a wide spread at 0.29% and very strong monthly liquidity at 16.4%. Now, that's probably a function of fund growth rather than trading activity. The other big player here is VG, the Vanguard FTSE Emerging Markets All Cap China Inclusion Index. Being a FTSE, it doesn't have Korea. China, Taiwan, India, and South Africa make up 78% of it. It's a big fund, $1.7 billion under management. 0.48 management expense. Okay, spread at 0.11 and nearly 4% monthly liquidity. So slightly higher cost. But what becomes important is the Korea part of that. And then the other two that are worth considering here, IZZ is a China fund. So if you're going to look at a non-China including emerging market fund, you might want to supplement that with IZZ. Or if you want to control the proportion of China in your emerging markets exposure, using IZZ as the swing number there is really good. It's a medium-sized fund, $470 million under management. And it does look, though, at Chinese companies that are listed on the Hong Kong Stock Exchange. So these are not Chinese A shares. These are Hong Kong listed shares. There's a historic argument that the Hong Kong market is better disclosure, better currency convertibility, better rule of law. Some of that differential may be disappearing as access to Chinese A shares becomes better, and the yuan becomes much more convertible. That's a $470 million fund, 0.6% management fee, modest spread at 0.13%, and good liquidity at 11%. The other one that's useful for a regional tilt, if you want to overweight Asia, and this is what we use IAA for. So IAA, it's an S&P Asia 50, so it's 50 largest companies domiciled in China, Hong Kong, South Korea, Singapore, Taiwan, and listed in either Hong Kong, South Korea, Singapore, or Taiwan. So not Chinese A shares here. This is a way of taking a global fund like a VEU and overweighting the higher growth Asian markets. And that's what we do in our portfolios. And the other one that I guess it's probably an honourable mention, although it is quite small, is FEMX. This is an active fidelity emerging market fund. Holds 30 to 50 stocks, so reasonably concentrated. Benchmarks itself against the MSCI Emerging Markets Index. Only $200 million under management. 0.99, like almost 1% MER. Quite a wide spread at 0.51 and reasonable liquidity at 2.8%. So that's really the emerging markets universe. And your choice is going to come down to, do you want to combine your emerging markets with the developed markets? Do you want to create your US exposure separate to the rest of your global? And do you want to be able to overweight Asian markets in your global, in your emerging or ex-US market, emerging in particular? Or are you happy with the index? And how do you feel about China A shares versus Hong Kong listed Chinese shares? All of those will go to play into your portfolio construction decision. So how do we put all this together? Well, if you spend time on Reddit or the internet generally, the favourite combo is VGS VGE. So that's the Vanguard Global Share Fund developed, which tracks the MSCI index, with VGE, which is the Vanguard Emerging Markets, which tracks the FTSE Emerging Markets Index. This is an interesting decision by Vanguard. I've never really got a satisfactory answer as to why that was the decision. But the consequence of Vanguard's decision here means that if you use the VGS VGE combo, and on Reddit it's usually paired or tripled with VAS for the Australian equivalent. So VAS, VGS, VGE is the Reddit trinity, I guess. But the consequence of making that choice is that you have no Korean exposure. In Korea, although it probably is 4 or 5% of the global index, it is home to some serious technology players and some probably market leaders in construction. So if you've got your Samsung, you've got Hyundai, you've got Kia, you've got a lot of heavy engineering. So to our view, our analysis is leaving Korea out of a global exposure is a fundamental portfolio construction flaw. You get the same answer if you replaced VGS with BGBL, for example. And how do you fix that? Well, you could add a little bit of IAA to give you that Korean exposure. But the consequence of doing that is you're probably going to be overweight China and Taiwan. We quite like that approach given the relative performance of these markets. A better choice would be IVV, IVE, IEM, the BlackRock options, or IVV. So again, this is giving you a US exposure. So IVV for the US, IVV for global developed markets, which is the MSCI Global Markets, and FEMX as an active Asian fund. Or if you want to take that and manage your Chinese allocation, you go IVV for the US, IVV for developed markets, EMXC, and then add IZZ. At Life Sherpa Invest, we use IVV VEU and use IAA to beef up our Asian allocation. And that gives us a weighted average management expense ratio of 0.15%. So that's pretty tight. And we're prepared to accept the Vanguard ownership risk and the US tax drag in VEU to buy that simplicity. For larger portfolios, we'll probably look at some of those 4, 5, 6 fund choices. But that's where we deliver our global exposure. So US allocation to the S&P 500 based on something more fundamental, closer to GDP type shares. We're overweight relative to GDP, but well underweight index weightings. VU for a combined developed emerging market, avoiding that risk of doubling up or missing out on Korea. And then we use IAA to beef up our Asian exposure, getting that greater exposure to the Asian markets, which recently have outperformed the European markets, for example. Small caps, generally you want to have an allocation to small caps because they crank up your returns generally. And indexes are a fairly poor way of getting access to small caps because you buy some small caps are small caps because they used to be large caps and they're not, or mid caps, and they're not doing particularly well. So active management in the small cap range adds significant value. So we like active managers on the small cap space. And so there's really not a lot in the ETF space. The two main players, the Vanguard Small Cap MSCI Developed Index, VISM. It's a $750 million fund, so it's reasonably significant. Being small cap, you would expect your management expense ratio to be a little bit higher at 0.32. That's pretty reasonable. Spread is a little bit wider at 0.12%, but it does have 4% monthly liquidity, so they're reasonably good vital signs. If you want something that's a little still algorithmically constructed, but applies a little bit more science and evidence to the answer. The Dimensional Small Cap DGSM, so that's a small cap including USA, ex-Australia, developed market. So it doesn't track an index, but their definition of developed broadly lines up with the MSCI definition of developed. It's a $656 million fund, 0.55 management expense ratio, and a spread of 0.24. That's a reasonably wide spread. This is a recent ETF equivalent of a long-standing dimensional managed fund. Monthly liquidity of 0.12%, so relatively low. But when you're moving into the small cap space, you really should be looking for an active manager, and preferably 2 or 3 active managers, so that you get a balance across portfolio construction approaches. So if we sum up what that means for your portfolio construction, we think you should look for a broad-based global exposure. We think you should manage your country allocations and don't rely on the index allocation. So, as I said earlier, these index weightings work really well within markets, but are terrible for allocating between markets and asset classes. If we did that, we would all be running 55% bond portfolios, which clearly is unsuited to most people. So come back to what you're trying to achieve and what the index weighting means for that. Be very careful mixing index providers, and be aware of the underlying index methodologies for compatibility. And, you really, and this might sound a little old-fashioned, but, reading the PDS is a great start. But you probably should spend some time reading the index methodology papers. They're not light reading, but it will give you a much better sense as to what you're actually buying. Certainly look at the holdings. All ETFs will have on their website a downloadable file of their holdings. Definitely worth having a look at. And where you're looking at emerging markets or small caps, consider active management. And if you want to know a little bit more about how we build portfolios at Life Sherpa Invest, go to lifesherpa.com.au/invest. I'm Vince Scully, and this has been Investing.
Thank you for listening to This is Investing. Any advice is general financial advice and does not consider your objectives, financial situation, or needs. You should consider whether the advice is appropriate for you before acting. Always read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs before buying any financial product. Vince Scully is a representative, and Simo Interactive, Pty Ltd, and Glenn James are authorised representatives of Money Sherpa Proprietary Limited, which holds Financial Services Licence 451289. And if you want further investing fun, the Quick Start Guide to Investing, as endorsed by Vince, obviously, is available wherever good books are sold, or there's a link in the show notes to get your copy today.